And I hope that one of the things that we're going to be able to deal with today is, wow, there's a lot of good stuff in taxation that will help you as a real estate professional. It's a marketing tool. There's tremendous advantages in real estate reference taxation that will allow you to, one, protect your clients when you see the red lights, then get them to a professional, a tax professional, in order to protect your client. It's your professionalism to know these red lights on your own tax return and on the tax returns of your clients. Now, when I was putting this together back in January, we were ready to do the first class. Roz came to me a couple days before the class started, and she wanted to know if I was nervous. And I said, no, I don't get nervous and things like that. And she says, well, I'm nervous. You know, she was nervous for herself, I guess. And she says, look, there's one thing I want to ask of you, Harold. And that is that you not talk about sex. And I said, you're taking my best material away from me, Roz. So I said, I'll get back to you on that. I don't know if I want to make that promise. And so I called my best friend, Neil, and I get Neil on the phone. I said, hey, Neil, Roz doesn't want me to talk about sex. And he says, oh, I get it. Maybe Roz wants you to talk about something that you actually know about. So that's what I'm going to do today. We're going to talk about taxation. We're going to talk about how taxation flows into your tax return and how taxation flows into your representation of your clients. Originally, of course, the name was Knowledge is Power. You know, wow, what a great name I came up with as a subtitle of this course. However, after doing this course a number of times and leading up to today, I realized that really this is Cover Your Ass 101. This is playing good defense. This is what it takes to play good D. And if you look at sports teams, any sport you want to talk about, all sport teams are based on defense first. If you play good D, then you can become offensive. And that's exactly what we're going to be talking about playing good D on your personal tax return and also playing good D in reference to your representation of your clients. This is not going to be a normal class. This will not be me reading a PowerPoint. This will not be, oh, we're just going to go plodding along. There's no plodding along. This is an extemporaneous presentation based on the outline. You've got your course material that's very nicely printed for you. You can take it home. People that are taking the online course, that's available to them by PDF, and they can follow along. But it's going to be jumping around because my brain will be jumping around. And as my brain's jumping around, I'll try and show you where on the PowerPoint. I got Jeff, my entourage today, Jeff from my office, sitting up front. And of course, the most important person in my entourage, my beautiful wife, Rosalind, the beauty in black against the wall in the back. Rosalind's always told me that when she was in school, she sat in the very last row. I was always like right here, you know, with my hand up, asking questions. Rosalind was the back because she didn't want to know, you know, when's class over? Okay, so you know, it takes opposites to make a deal work, and then Rosalind and I certainly have that going. So Rosalind says to me, we have to have hand signals. I said, what? What can we possibly need hand signals for? Well, what about bathrooms? What about the bathroom? I said, what could you possibly be nervous about in the bathroom? She says, what if you're after the second break? Because there's 2 7.5-minute breaks, okay? What if you're after the second break and you, Harold, what if you have to go to the bathroom? I say, this is not something I think about. This is not something that would come to any guy that he's got to worry about a bathroom break. But if it happens, I'm sure that I'll figure a way out. No, we have to have a signal. Okay, Roz. Okay, what's the signal? So it goes like this. I said, that's so violent. So violent. I say, okay, this. And then she goes like this. And I said, what's that? She says, "You're boring me, move on." So I started having these nightmares where I turn over to her in the middle of the night with amorous intent, and she's sitting there going like this, you know, "Move on, you're boring me." Okay, if you look at my background, which is slide number 2, and I've purposely run by the purpose of why you're taking the course. So let me back up and talk about that first, which is actually important to me. And you're taking this course, I would hope, which is course objectives, slide number 3. So I'm going to go slide number 3 first. You know, you want to be aware of the tax issues. You want to know when the red lights occur. You want to know what they feel like. You want to know what they look like. And the minute a red light occurs, you want to do what? You want to be very careful on your own tax return if there's a red light blinking on your tax return. And if there's a red light in reference to your representation of your client, you want to get your client to a tax professional, CPA, tax attorney, etc. I wrote my own thing here, and that's that it would be important to me that you walk away with a degree of sophistication. You don't need to know tax law. No one's trying to make you a tax preparer in this seminar. What I'm trying to do is to make you aware. We'll get to the vocabulary in a few seconds. We'll do that. So what I'm trying to do is increase the degree of your sophistication. That degree of sophistication will allow you to market your professionalism better, represent your clients better, and therefore we raise the overall sophistication of the industry. And looking back at my background, you know, we were just talking earlier before we started about JD after my name, and that's the Juris Doctorate, because I have a law degree and all these things where I, you know, graduated from Bolton and SC and things like that. But when I first started out, I rented a small gasoline station up in Makwa. That's a 9x9 office with the overhang, and the gas tanks were still in place, mobile gas tanks, when I first moved. And I put a little sign out that said Harold Berman JD, and then people would come by and say, "Hey, are you the jungle director? Or are you a juvenile delinquent? You know, exactly what are you?" Of course I said, "Of course I am, of course I am." So we're going to go and we're going to jump to vocabulary, which is slide number 4. And this is Rosalind's favorite. And I'm going to tell you why this is Rosalind's favorite, the vocab, as she would say. Because if you get your hands around the vocabulary, if the only thing you walk away from in this course is the vocabulary, you've come a long way. Because in this vocabulary is the launching point to everything that we're going to be talking about today. So you'll notice that the first vocabulary word that I've set out here is exclusion for the sale of your principal residence. So let's talk about what a principal residence is. It's where you sleep over half the year. And what's the exclusion? If you live in that principal residence 2 out of the last 5 years, the first $250,000 of gain if you're single or had a household, or $500,000 if you're married, is excluded. The gain is excluded. There's nothing like this anywhere in the tax law. There's nothing that allows you to sell a capital appreciating asset, and the personal residence is the most important investment that most people make, and we're going to be talking about rental property too. That's also important. But here's an exclusion up to $500,000 of gain, 0 tax. This is a fantastic part of the tax law that makes owning your personal residence extremely advantageous. So when you're going out there and your potential client is talking about renting versus owning, sure, if they're in a 33% tax bracket and they're paying $2,000 a month in rent, they could pay $3,000 in a mortgage. Okay, the math can be done fairly expeditiously. But it's more than that. The reason you want to own your personal residence is to take advantage of this exclusion so you can sell it at a gain and not pay taxes on that gain. And you can do that every 2 years. This doesn't exist anywhere in the tax law. If I own IBM, I want to sell IBM, I want to buy Apple. If when I sell the stock of IBM, I have to pay taxes on it to then buy the Apple stock. Okay? There's no exclusion on that gain. The next vocab word is also unbelievably important. Long-term capital gains. Holding a piece of property, an asset, it applies to all assets, but I'm talking about real estate right now. You hold a piece of real estate for a year and 1 day. You get long-term capital gains treatment. Well, what does that mean? Well, first of all, for certain individuals, there's a zero tax rate. If you're married, up to approximately $77,000 of AGI. We'll be talking about AGI in a second. The first portion that fits within that category, there's a zero tax rate. So therefore, certain capital gains have a zero tax rate. The majority of capital gains have a 15% tax rate. If you're in the highest tax rate in the United States of America, 39.6%, the capital gain, long-term capital gains rate is 20%. Obviously a 19.6% differential. This is incredible. When you do what I do for a living, your first duty is to create no pain. Okay? Anesthesia. We don't have anesthesia, but okay, no pain. The exclusion, zero tax rate for long-term capital gains in certain tax brackets. No pain. Then, if there's going to be pain, you want the least amount of pain possible. 15% tax rate, 20% tax rate, much lower than ordinary income. Well, what does this mean in your professionalism? Well, it could mean elongated escrows. It could be that we have a longer escrow so that your client, who's the seller, has held their property for a year and 1 day. So they get long-term capital gains on that transaction. And it's not that you're going to tell them this, although you can talk to them about long-term capital gains. It's that you're going to get them to their tax person, their tax professional, so they can come up with a strategy like elongated escrows. Now, everyone in this room will probably qualify to be a real estate professional. And as a real estate professional, you will get preferential treatment under the tax law. In order to be a real estate professional, you have to work over half your time in real estate. You need 750 hours per year to be a real estate professional. Now, what does that mean? If you have rental property, if you own rental property and you're a real estate professional, the losses on the rental property are all deductible. You get a get-out-of-jail-free card around the passive loss rules. You get to deduct 100% of the losses on your rental real estate. The key here is the minute you own your first rental property, you make an election, which we will be discussing as we move forward. You make this election, it's a one-time election. All your rental losses are deductible. And this is a tremendous advantage to those of you who in your career will accumulate rental property. And you're looking for investments for yourself. What better investment for yourself than real estate itself? Why? Because you know what a good piece of real estate looks like. You know what a good buy looks like, and you know what market value is when you sell it. So when you start thinking about what your own portfolio, your own investment portfolio should look like, real estate's going to play a huge part of your investment portfolio. So number 4 on this list of vocab, we got AGI. So we had a woman here who is the sponsor of today's presentation. She was talking about loans. You're going to know that I don't understand anybody who's a banker. I don't understand any of them. But it's important that you understand not only the ideas that are being presented to you by loan brokers, because you have to help your clients get loans, but when you look at your own tax return, if you look at your own tax return, the bottom line of the first page of your tax return is AGI, Adjusted Gross Income. And basically the first 2 pages of your tax return is a compilation of everything that follows. So on the first page, you can have your W-2s, you can have your interest income, your dividend income, your rental income, your Schedule C from your commissions and expenses. A farm is a Schedule F. You can have all those schedules, and that'll get you down to the bottom, AGI. And AGI is used a lot by loan brokers and banks to give loans. So it's an important number. Then you have your itemized deductions. What's in itemized deductions that's helpful to us as real estate professionals? Well, the first thing is real estate taxes are deductible as itemized deductions. The second thing is the loans on your first and second residences. It's limited to aggregate loan of $1.1 million, but you can deduct the carrying costs. This is very unusual. You get to deduct the carrying cost of holding a capital appreciating asset. Yes, Cindy?
The 1.1, is that for the 2 residences or each?
That's a very good question. Cindy's question is, when I'm talking about the aggregate loan balances, 1.1, is that the aggregate of the first and second residence, or is it for each one, so it's 2.2? It's 1.1. It doesn't matter whether it's all on the first or all on the second or a combination of the first and second. It's 1.1 aggregate, and if it's above 1.1 aggregate, you mathematically have to reduce the interest and only have it deductible as it applies to $1.1 million of loans. Now, you all have groups that are that go to Washington and make appeals, lobbyists on your behalf. And we have an election coming up in November, a very important election in November and beyond. And there's going to be a new tax law in November of 2017, no matter who is elected. One of the most important things to the people in this room and who are watching online is the deduction of the interest on your secondary residence. That could be taken away, and that would greatly harm you in this room in your marketing of the buy and sell of secondary residences. And so I would urge you to talk to your lobbyists and pay attention to the new tax law that's going to be coming out in November of 2017. Now, a lot of people in this room have preparers who are who take the home as a deduction, home office deduction. And I do in my office, I just do it in a certain way. If you take your home office deduction and you depreciate your personal residence, a room in your personal residence, there's a real problem in doing it that way. And the real problem is when you sell your personal residence, you now have something that's inside that personal residence that has to be cut off, set aside. You have to allocate the sales price between the room and the rest of your personal residence. The $250,000 or $500,000 exclusion does not apply to that room. 100% of that room has to be used for business. Well, what does that mean? I can't take a nap? Does that mean I can't watch a TV show that I like to? You can't have any fun in your home office, according to the IRS. There's no fun, there's only work. Okay? There is a safe harbor rule of $5 a square foot. No depreciation analysis. That's beautiful. $5 a square foot, up to $1,500, 300 square feet. $1,500 can be deducted without it affecting your ultimate sale of your property. That's one option. We use that a lot in my office. We also use actual expenses. What did you do in that office? What did you buy? Did you buy art? Did you buy a new desk? What did you do in the office? The actual expenses are deductible. You can't do both, but you can't double dip, but you can do one or the other. And in many cases, it works out better to just use the actual expenses.
Is there actually a place where you check off that you're using the safe harbor, or I don't recall ever seeing that?
No, we do not use any kind of checkoff method. We use the $5 a square foot and we add that on to office expense. It's really important not to do anything on your personal tax return that creates blinking red lights. And this whole thing of home office is a blinking red light. There's a special form. I've never done it in 39 years of tax preparation. I've never used that form. I don't want to know the form number. I don't want to know anything about that form. That form is trouble, okay? So I stay away from that form. I deduct, I give my client their bang for their buck as far as the expense. I just don't show it in that way because one, it gets audited a lot, and number two, it affects it when you sell the property.
Question?
Sure.
Okay, so if somebody's been doing it for several years and they stop, and then they sell their place in, let's say, 2 years, is there any red flag?
Well, the question that's being asked is a really, really good one. If I was depreciating and taking that form for home office, and then I stop doing it and I go to the safe harbor, can I sneak through the process of selling? Sneak is a bad word, but can I finesse the sale and not deal with the depreciation that was taken in the past? I would say you can finesse the bifurcation of the sale, but you cannot finesse the depreciation that you took because that has to be recaptured at the point of sale. So I would say you're kind of like in the middle ground. I'm taking the middle ground on your question. It was a really, really good question. Now, if you look at number 7 in the vocab, it's accumulated depreciation. Accumulated depreciation comes in all the time dealing with rental property. So we talk about rental property, and a client comes to you and says, hey, you know, I've had this rental property for a really, really, really long time, 20 years, and I bought it for $500,000, and I'm selling for $500,000, I don't owe any taxes. Wait a minute. Accumulated depreciation has been taken for 20 years. This person has a tax problem on accumulated depreciation, which is recognized at the point of sale and taxed at 25%. So accumulated depreciation, which is bypassed in most taxpayers' mind, is a huge tax issue that, of course, tax professionals deal with all the time. And the next vocab is a very important vocabulary to me, tenants in the entirety. So you have to be married, start with that. You have to be married to use tenants in the entirety. Tenants in the entirety is used for asset protection. Now, what you're going to see all the time is tenants in the entirety being used for personal residence owned by a husband and wife. You'll see the title, tenants entirety. It should be almost uniform. Okay, so allow me to diagram the state of the art on where we are in taxation, trusts, estates, and things like that. Okay, so in the top left-hand corner, I'm drawing a square, and basically this is a business. Most businesses are either S corporations or single-member LLCs, and sometimes you'll see operating businesses that are dual-member LLCs. I like LLCs with real estate. I love S corporations that deal with business. A lot of baby boomers have attempted and have saved a lot of Social Security tax dollars by using S corporations. And then they have another business over here. Okay, down here is their personal assets, their personal life. Over here is land. And over here is trust and estates. Okay, you remember I told you that I wasn't going to talk about anything I didn't know about. This is the one area, trust and estates, where I'm not and would be considered an expert. The rest of the stuff I'm talking about, I would be considered an expert. But I'm not a trust and estates lawyer. So we have to get that straight. But I'm going to talk about trust and estates anyway. Okay, now you have two businesses. The common mistake made when you have two businesses is to start moving funds between the two businesses. Why? Because you want these two businesses to have Maginot lines. This is what lawyers do. They create these trenches, and what they create these trenches is they don't want a creditor from over here to get this. And they don't want anybody over here to get anything in your trust and estates. And they don't want anything you do out in public, okay, which you may have an umbrella policy, which will only cover it if a camel is there at the time of the incident. They don't want anything of your problems personally to get at any of these other assets. So they want a separation between assets. You start moving funds directly between companies, it's a contamination of the separation. That sounded really good. Contamination. You've contaminated the two things and made them one. Go ahead.
Does that also refer to reimbursement between the two businesses?
That is, okay, so the question is what I'm talking about deal with reimbursements between companies. But in order to have a reimbursement, that means this company paid something on behalf of this company. Well, why the hell is that happening? That shouldn't be happening either, because now it looks like it's one company, it looks like a personal holding company, and it looks like there isn't a separation between these two entities. So what do? You send the money this way, and then from you personally back up to this business. Okay, this business needs money to go buy something. The money's sitting over here. You don't have it go directly over, you have it go to you first. Okay, now, land. Land can, you see land in LLCs in different ways. You can see it as a mothership, okay, where there's 4 or 5 LLCs in this mothership, each single member LLC owned by the mothership. I don't particularly like that. I like individual LLCs for each and every piece of property. So remember I was talking about tenants in the entirety. You're looking for asset protection. You're looking so that it's not easy for creditors to get at your hard-earned assets. Tenants in the entirety make it difficult because if a claim is against the, I'm going to say it's against the husband, it's just a generic way of me talking about a situation. It's not gender biased, I hope, in any way. But let's say it's the husband that gets in trouble, okay? Very, I don't know why that is. The husband's always getting in trouble. Okay, the husband's in trouble. He's got a claim against it, but it's not a claim against the wife. Well, if the person gets a judgment, they can go against the in tenants in the entirety. They can go and put a lien on the property, but they can't execute the lien. They can't have the property sold because the wife's portion does not have the lien on it, and they can't force a sale. So it allows the asset to remain there, and then hopefully the judgment can be solved or negotiated. You're making it hard for them to get paid. Maybe they'll take a certain percentage on the dollar. You start negotiating the payment of the lien. So that's where tenants entirety come into. So Roz and I had a will, had a revocable living trust. Each one of us had a revocable living trust. It was done by a friend of mine who has since passed away. And this document was literally this thick, because my buddy believed that he wanted to create a document that was so complex that no one could possibly understand it but him. I didn't understand it, and I'm a tax lawyer. Roz certainly didn't understand it. So my friend passed away, so we went to our current lawyer, who just loved this guy, and we came to him, and we wanted the KISS syndrome. Okay, we want a KISS, you know, could we keep it simple? Okay, so we get in the room, and we have different issues. Roz has a thing for diamonds, okay? She's the only woman probably in the universe. Okay, she has a thing for diamonds. She likes diamonds, and we have 2 daughters, and each one of them have their eyes, like they're engraving their initials on the backs of the diamonds from their eye, and the intense, okay? So we go and we say, you have to, when you get over here, you have to distribute in your revocable living trust. Revocable means you could change it anytime you want to. Revocable trust, you have to figure out how to divvy up your personal assets. So I come up with this clever idea because my father was a gambler. When you grow up with a father that's a gambler, there's certain things that you will experience that other people will not experience, for good and for bad. So I used to go to Vegas a lot as I was growing up, and I started playing craps next to my dad when I was about 16. Everybody knew my dad. My dad was very, very well known in Vegas and at various casinos. And they let me play. And my dad was a don't player. Those of you who have ever played dice know that you're betting against. My dad was betting against the dice instead of for the dice, because there's a slight mathematical advantage, and my father was a grinder and he was a mathematician. And he'd sit there and talk to me about the odds, and he talked to me about taking money off the table. So when I sat down with our lawyer, I decided to allocate the diamonds by taking out a deck of cards, taking the jokers out of the deck, having my 2 daughters pick one card, aces high, the highest card goes first, and then we allocate from there. And this is how tortured I am. I have to go back and come up with some gambling analogy in order to split the assets up. So we get to the end of the conversation, and I'm talking to the lawyer, and he says to me, you know, you have some property, Harold, with Roz, and I think you should own it single member LLC, tenants in the entirety. And I went, whoa. First of all, it was the first time that I had heard that a single member LLC could be held tenants in the entirety. Now this is like groundbreaking to me, because tenants in the entirety is a tremendous asset protection. If you go dual member LLC, then you're required to file a partnership tax return. It's very expensive to hire a professional to do that. And so this whole idea of single member LLC, tenants in the entirety, comes in the fold. So listen to what we did. We did the revocable living trust. We put nothing in it. We held everything, tenants in the entirety, single member LLC. When the first person dies, which will be me, why? Stress is killing me. Stress, I'm getting killed by stress. Okay. When I die, Roz is under direct direction to go to the lawyer and then move things to the trust. The trust are documents to talk about the distribution of assets when the second person dies. When the first person dies, there's all kinds of information that tenants in the entirety would immediately fold to the other person that holds the property, and you would have operating agreements that said that, et cetera, et cetera. So now tenants in the entirety, which was a minor player. I mean, 10 years ago, we probably would just, talk about it in the ownership of your personal residence, but we certainly wouldn't be talking a lot about it in asset protection, in trusts and estates, in all these other areas. So that becomes a rather interesting development as we've moved on, and so now we've reached the issue of the preparation of your own tax return. And in the preparation of your own tax return, before I get to that, I want to talk about the fact that every person in here is a marketing person. You're very, very fortunate. First of all, the asset that you are marketing is the most important asset that anybody can have. I mean, we're not talking about their health and their children and everything else. It's the most important asset. We can go back in the history of mankind. We can go back to caveman times. We can go back to the Dark Ages where there were serfs and people working, and then we can go to just before sharecropping in the southern part of the United States. Those that had property were at the top of the socioeconomic ladder, and those that did not have property were at the lower end of the socioeconomic ladder. You are marketing a precious asset. You're also people, so you get to have good time. So let me see if I have this straight. You get to have a really, really good time. You get to be very, very social. You're dealing with the #1 asset in the United States of America. What a country we live in. So when you do your own personal tax return, and of course you hire a professional to do it, there are certain red lights that should turn on when you lead the following. And if you look at slide number 9, you'll see that I've laid out certain of these things that affect your personal residence. And I'm going to go to number 3 first. Because I'm in real estate, I can deduct 100% of my travel, entertainment, and auto expenses. Okay, so there is a pig roll. I'm going to spend a lot of time on the pig roll. And now we're at the pig roll. Never deduct 100% of anything. Let's take your automobile. 89.4%. Okay? 73.2%. Not 100%. There's always personal usage of everything. So then you say to me, okay, but when I go to drive to Foodland, I'm going through Foodland and I'm buying things. I'm always marketing myself. And I'm saying, boy, you're very clever in that analogy. But you do have a personal life. Many of you have children. If you are a pig, you will get killed. So if you choose some odd number that you have calculated, so somebody comes into me and they say, okay, my entertainment is $2,000. I immediately say, do you know what the odds are of having 3 zeros in a row? Do you have any idea? I mean, it's mathematically outrageous. But the same person comes in and says, oh, my entertainment was $2,143. I say, wow, that's a great number. Why? There's no zeros in it, okay? So 1, we don't want to be a pig. And number 2, and we don't want to deduct 100% because, okay, you have things that are partly for your kids that you also market at those things. So you have to allocate your personal portion and your business portion. These are actual statements of some of my many clients over the years. And number 4, I don't have to be concerned about documentation. Right there. You can stop right there. Okay? Documentation is the key to the issue. The better your documentation, the more aggressive you can be. And what's documentation? The most important piece of documentation is your appointment calendar. Because listen to this, this is fantastic, being a lawyer. A contemporaneous, that's a big word, contemporaneous notation in a diary is as good as a receipt. Over the years, I've noticed certain things. Pretty much this is a generalization. People in sales and marketing are terrible at documentation because all their momentum is forward, and they don't think about their rear end. They don't think about defense. They only play offense. And if you only play offense, somebody's going to sneak on your backside, and that is a vulnerability. Don't let it happen. So documentation is important. The receipts. Okay, you go out to dinner. the person you had dinner with. And it cannot be your significant other every time. You can't be writing your significant other's name. And what did we talk about? We talked about business. Yeah, right. Okay? But if you saw a client there and you bought him a glass of wine and you talked about a piece of property that you're working on, or that they might make referrals to you, and you write their name on the visa and you enter it contemporaneously in your diary, now I got two things. I got a contemporaneous notation in my diary. I got the visa receipt. I got the notation when the visa monthly statement comes to me. That's 3 forms of documentation. Man, a triangular documentation. This is the kind of stuff that people I get crazy goosebumps thinking about triangular documentation. I got it from the mountaintop, I got it from the ground, I got it from the drone. I got some documentation here. Okay, ready? I can discard my credit card statements and my appointment calendar. Please don't okay, you have to keep your receipts up to 3 years after the filing of your tax return. Here on Maui, we have a very nice beach, Baldwin Beach, and everybody thinks that the bonfires on Baldwin Beach are bonfires to warm the fishermen, but that's not the case. Half those bonfires are statute of limitation fires to destroy old documentation that you don't need anymore. So 3 years, you hold the documentation for 3 years, then you can get rid of it. Number 5, don't you love this? I can make up the documentation if I need to later. Hard to make a contemporaneous notation 2 years later. Very problematic. Number 6, I can file my income tax late even if it's years late. The tax law is all about being good taxpayers, abiding by the rules, filing your tax return on a yearly basis, and paying your taxes. That's what it's all. It's all about compliance. Now, some of my best friends in my life are dentists. And you would think that a tax attorney and a dentist have nothing in common. However, we do have something in common. We deal with pain. Secondarily, no one would come to us and they weren't forced to. The benefit of being a dentist is you get anesthesia. A tax return is a root canal without anesthesia. Okay, but it's all about compliance. And once you get into the habit of keeping good records, then it's just a matter of course. And there's nothing that I'm saying that should interfere with your being marketing people. There's nothing that should interfere. You can play tremendous offense while playing a little bit of defense. In this book, David and Goliath, that was written by Malcolm Caldwell. Malcolm Caldwell is a very famous author in the United States. He's written Tipping Point, which I highly recommend because a lot of marketing ideas in Tipping Point. But he wrote a book that I was fascinated with. It's called David and Goliath. And it's basically got the theory that David, if he walked up to Goliath in a sword fight, would be dead in 3 seconds. But instead, he uses his assets, his skill set, and he backs off and he uses artillery, which is a rock and a sling, and he uses his quickness, being fast afoot, and he tilts the game to his skill set. It's amazing that in the real estate industry we don't have more courses or more help in marketing and sales. We should know how to ask closing questions. We should actually look at our skill set and tip the game to our skill set. If we are verbally gifted, we would be more likely to use our verbal skills than our texting skills. Like myself, I don't text, I don't use electronic communication at all. I use my verbal skills because I was given this gift, and I want to use my gift because I have this gift. Whatever your gift may be, you want to use that gift. So I want us to spend a second talking about marketing, because we don't get any help in marketing. It's all about packaging, isn't it? It's about packaging, taking a negative and making a positive out of it. So Cindy McCormick and I were talking earlier about when I was single, and when I was single back in 33 years ago, I kind of ran out of eligible ladies to go out with. So I had to market myself. It was dry out there. It was a desert. Okay, so I had to figure a way to market myself. So listen to what I did. I took 20 of my clients that I knew, and I said, the person that introduces me to the woman I marry, I'm going to do their tax return for the rest of their life for free. A finder's fee, right? Genius stuff. Genius stuff. Okay, so there was a guy named Shelley. Shelley comes to me and says, I found her. You found who? I found your wife. I said, really? So he gives me a call, Rosalind. I've talked to her a couple of times. And now comes the date, the blind date. Those of us who are males will completely, in the room and online, will completely relate to my experience going on this blind date. So I talked to Rosalind a couple of times. So I go, it's 7 o'clock at night, it's dark. I knock on Rosalind's door, and the door opens, and in front of me is the singularly most unattractive woman I've ever seen in my entire life. But I try and gather myself, okay, so I don't make a complete ass of myself. I said, hi, Rosalind, I'm Harold. And she says, oh, no, I'm not Rosalind, I'm Bernadine. I don't think I wiped the sweat off the top of my head, but in back of my mind, I said, before this happened, I said, I'm going to kill Shelley. He's a dead man. He's a dead man walking, man. Okay, so I walk inside, and there's a drum set. I happened to play drums at the time. Now I'm a guitar player, but I was a drummer at the time. Who plays drums? Rosalind plays drums. Rosalind comes out. She's absolutely gorgeous. I go, now we're talking. Okay? So look, finder's fees, marketing, thinking outside the blocks, playing to your skill set. These are all part of being in marketing and being in the profession that you're in. The current status of the Internal Revenue Service, they're really in trouble. They're a damaged agency. They're a semi-autonomous agency in the executive division of the government of the United States. They of course screwed up a lot of the Tea Party's applications for 501c3s, so the Tea Party's upset with them. A lot of Congress is upset with them. They can't get anything done. Their budget has been cut back to 2008. So here's the good news: less audits. That's tremendous good news. Here's the bad news: try to get something done. Okay, so you can't get things done. They're dropping millions of calls. They're really, really, really in trouble. So when we start looking, we're kind of at slide number 11. We're kind of going down slide 11 to kind of look at a tax return and what it looks like. And we're down, so you've got your W-2s, you've got your income. We're going to be talking a little bit about your Schedule C. Let's talk about your Schedule C right now. First of all, your Schedule C, which is for most of you, some of you who are brokers have the viability of being S corporations. But in Hawaii, you can't be an S corporation unless you're a broker, because every corporation has to have a broker in charge. So most of the people in this room who are sales people will have a Schedule C. There's two questions in the Schedule C I want to alert you to. Are you required to issue a 1099? Yes or no? Second question. If you're required to issue a 1099, did you issue a 1099? So someone says, yes, I'm required, but no, I didn't do it. I mean, you might as well blow the tax return up. So if you're going to say you did it, which means you paid somebody as an independent contractor over $600 for the year, you got to issue a 1099. So if you did, say that you did it and issue it. And if you didn't, then you're going to say no, no, that you're not required. So that issue is on the Schedule C. What are they looking at? Traditionally, they look at travel, they look at entertainment, they look at the use of your automobile. They look for something that stands out because it's not mathematically congruent. What I mean by that is the symmetry of numbers, which we'll get to in a moment. So if there's a number we know there's one number that's going to call out to Harold Berman every time. The number's 0. I'm a mathematician. 1 through 9, I'm in love. The number 0, I'm running. So stay away from zeros. Also, stay away from things that don't make sense, and make sure your tax return has some symmetry to it, that the numbers make sense. So if any one number is too big, cut it up into 3 categories and make it smaller. Just be inventive in your categories and cut it up. Again, your diary is the most important thing that you can have. And let's talk a moment about the burden of proof. The burden of proof is different in the preparation of your tax return than it is in an audit. In the preparation of your income tax return, the burden of proof is reasonableness. Well, what does that mean? A reasonable basis is the formal words for the burden of proof to do something on your tax return. It means you have to win. There's no definition. You have to win, let's say, 1/3 of the time, which means you could lose your argument 2/3 of the time and still take it on your tax return. If you get audited, the burden of proof is 100%. So you can take a position on your tax return if you can win 1/3 of the time. Now, I use 2 forms of tests in my office in reference to taking a deduction. The first is the smell test. You take the analogy. Okay, I went to Honolulu to look at property in Honolulu. Okay, I saw the stones while I was there. Okay, I went to Honolulu to see this property, and I'm going to deduct the trip. It was business. You put that underneath your nose, and if it stinks, you don't do it. And if it doesn't stink, then okay, let's do it. Then that's the smell test. Then there's the mirror test, the laughter test. You stand in front of a mirror. I'm going to Honolulu on business. If you laugh, you don't do it. If you can keep a straight face, you can do it. So if it passes the laughter test, if it passes the smell test, and you're going to say to me, well, Harold, I know some people that can't smell and will never laugh. And that's the difference. Every tax return is different. In a scale of 1 to 10, 1 being I want to pay the most taxes possible, create the lowest risk of audit. 10 is I don't want to go to jail, but just short of going to jail, I want every deduction possible. Well, there's people that want to be a 12. So you have to go, wait a minute, man, come this side of 10. Come this side of 10. Let me introduce you to single digits. Come this side of 10. Here we are, single digits. Okay, and the people who are 1s, they should go to CPAs. I'm the wrong person, because CPAs are extremely conservative, and they're very good at these 1 tax returns. I usually think that a 1 tax return is too passive. And if you're looking at this, so each person is different, and a husband and a wife will differ. The husband will want to be a 9.3. The wife will want to be a 5. So you have to compromise, and you wind up in the compromise, which marriage is a compromise, Rosalind. And it's, I want to be clear that I'm saying that because I need to compromise more. Okay. So in looking at this, you say, okay, now we have to be reasonable. You always want to be reasonable. and you want to look at your tax return and see if there's anything in there that catches your eye. And when you look at Schedule E as in Edward for your rental property, there's 2 questions. Guess what the questions are? Were you required to issue 1099s? Yes or no? Did you, if you were required to, did you issue the 1099s? So you got the same questions on Schedule E and F and C. So make sure that you handle those questions right. Now, what does the IRS hate on a Schedule E? I'll tell you what they hate. Travel and the use of your vehicle for a rental property, particularly if the address is on the same location, basically, or near the same city that you're living in. So you live in Kahului, and you have a rental property in Kahului, and you're deducting all your automobile expenses. Or you own a piece of property in Oregon, and you've got $10,000 of travel on that rental schedule. So where should it be, Harold, if it's not under automobile and travel? It should be under repairs, because that's what you're using your car for, and that's what you went to Oregon for, was to do repairs. And while you're in Oregon, do the repairs. So this is what's happening when you look at your own tax return, and you're looking at ways to make it work for you. By way of introduction, we're going to break really soon. By way of introduction to the passive loss rules, we talked about them earlier in reference to your being a real estate professional. Basically, the passive loss rules, which are on slide number 13, those passive loss rules came in 1986 when Reagan was president. He wanted to simplify taxes, and we have the largest, most complex tax system ever created in the United States of America. It was a trade-off. He got rid of all these games that were being played in tax schemes in which people would put up $100,000 and get $300,000 of deductions in leasing and cows and things like that. They got rid of that for lower tax rates. And in this, real estate got caught up. The passive loss rules. You were only able to deduct $25,000 of losses on your real estate losses for someone who's not a real estate professional. Now, it doesn't apply to you in this room, but it applies to clients. So you have to know about this, that there's these passive loss rules, and if you earn too much money, and too much money is defined as $150,000 AGI for a married couple, you can't deduct any of the losses. So what happens to these losses? They go up in the air like a balloon, they come back down the next year. And then you can't use them again, they go up in the air, they come down. When do they get used? When you sell the property, when the client sells the property. And that's what the passive loss rules look like. So, now we've come to the end of the first hour. Let's take our break, 7.5 minutes.